To truly grasp an ETF's value proposition, we must look beyond its ticker and fluctuating on-screen price. Its efficiency, liquidity, and tax advantages stem from an ingenious and often misunderstood creation and redemption mechanism, which fundamentally differentiates it from mutual funds. Unlike traditional mutual funds where investors buy and sell shares directly with the fund management company, transactions typically settled in cash at the day's closing net asset value, ETFs operate via a two-tiered system, the primary market and the secondary market. Retail investors, like us, operate in the secondary market, buying and selling ETF shares among ourselves through exchanges, just like common stocks. The primary market is the domain of large, specialized financial institutions known as Authorized Participants, or APs. Only they can interact directly with the ETF issuer to create or redeem large blocks of ETF shares, termed creation units, typically ranging from 25,000 to 200,000 ETF shares or even more. The key to this process is that for most equity and many fixed income ETFs, creation and redemption are predominantly done in kind. To create new ETF shares, an AP assembles and delivers a basket of securities, the creation basket, that closely mirrors the ETF's portfolio, example, S&P 500 stocks in their correct weightings, to the ETF issuer. In return, the AP receives an equivalent number of new ETF shares. To redeem ETF shares, the AP delivers a block of ETF shares to the issuer and receives back an underlying basket of securities, the redemption basket. This in-kind mechanism has profound implications. 1. Operational cost efficiency. The ETF fund itself doesn't need to constantly buy or sell securities in the open market to meet investor cash inflows and outflows, as a mutual fund does. This minimizes the fund's internal transaction costs, brokerage fees, market impact, which would otherwise erode performance. 2. Tight price alignment, or arbitrage. This mechanism enables a powerful arbitrage process. If an ETF's market price on the exchange deviates significantly from its per-share net asset value, the net worth of its underlying assets divided by the number of shares outstanding, APs have an economic incentive to intervene. If the ETF trades at a premium to NAV, APs can buy the underlying basket of securities, create new ETF shares, and sell them in the market for a profit. If it trades at a discount to NAV, they can buy ETF shares in the market, redeem them for the basket of securities, and sell those securities. This arbitrage activity tends to keep the ETF's price very close to its NAV, benefiting all investors. 3. Superior tax efficiency, particularly in the U.S. Because the ETF fund delivers securities in kind during redemptions, rather than selling them for cash to meet the redemption as a mutual fund would, the ETF can avoid realizing internal capital gains. It can deliver out the securities with the lowest cost basis, deferring or even eliminating the need to distribute capital gains to its shareholders. This contrasts with mutual funds, which often must distribute capital gains annually, creating a taxable event for their unit holders, even if those unit holders haven't sold their shares. This in-kind creation and redemption system is one of the most significant innovations of the ETF structure and underpins many of its competitive advantages.